As Prime Minister Modi and his cabinet get set to begin their second term in the corridors of power, Credit Suisse has put out a note listing out priorities for the government. And joining us now to talk about that in greater detail is the India strategist and co-head of Asia Pacific, Neelkanth Mishra. Neelkanth, so good having you. Good morning. Thanks for speaking to us at Bloomberg Quinn. Would you believe it's back to fundamentals from day one itself? And are the fundamentals looking like in need for some urgent action? Or can it move around at a slightly more lenient pace?
Yeah, so I think it has to be back to fundamentals. For the last several months, if you told anyone investing in the markets that, look, the economy is slowing down, that there are these stress points, and it doesn't look like it'll get addressed very quickly, the response would be, okay, just wait for the elections. And I think everyone was anticipating that if the verdict resulted in either a negative or a positive surprise, there could be significant market volatility, and that would supersede anything that fundamentals would have driven on the stock side. And so whether justified or not, that is the way people are behaving. Now that the elections are over, I think the questions will be as to what next. Is that there is a growth slowdown is, I think, now consensus. The question is, how quickly can we get out of it, and what can the government do? I don't think the slowdown is steep enough to convince the government to take action, right? So it is important for us to realize that any decision the government makes on the political side uses some political capital. So just like you and I would use our savings, or a businessman would use the capital, if there is a capital earned through a historic verdict like what the BJP and the NDA have won, that capital will be used for a certain purpose, and there has to be a certain ROI on top of it. And if the slowdown is not as steep as perhaps the rhetoric says, for example, I mean, there is of course clear auto sales weakness, airline traffic is weak, oil demand has started weakening, but there are pockets of strength. So cement and steel demand are not weakened that much. The staples companies, the largest ones, are still reporting high single-digit kind of volume growth. So it is not, doesn't look like a screeching slowdown, and therefore there can be a sense of doubt. If you're a policymaker, do I really need to intervene? And will this somehow correct by itself? It's the same thing that is happening on the monetary side, because I think the government actually, even if it wants to address the slowdown, does not have the fiscal space that, and I think there is less of an intent, at least in this government, to use fiscal tools or at least on the consumption side, to accelerate growth. So what is needed is actually, I think, monetary action in terms of improving the supply of money, that is M3 growth. For that, we may need very sharp rate cuts. I think term premiums need to be brought down. For that, signaling from the MPC is required. There's not much that the government can really do. And plus, as I was saying earlier, it is a bit presumptuous on the part of every participant in the market that somehow the political capital, which is so hard earned after months and months of campaigning and a lot of strategizing, should be spent on things which we want them to spend on. I think the government will have its own priorities. And governments also, their political parties, they have political and social agenda as well. So if they have to use the political capital, it is not necessary that it will be used on things that matter to us for the next 3 to 6 months. So we have to temper our expectations on how fast the government acts on the economy. They will undertake, I think, some reforms. There is quite a bit on the judicial side, on direct taxes, on administrative reforms. I think they may take another shot at triggering low-end housing, or accelerating or catalyzing the construction of low-end housing. I think PSU bank consolidation could see a much greater impetus than it has seen in the last 5 years. So there are things on the economic front they will work on, but nothing which I think will address the steady slowdown that we've been seeing the last couple of months.
All right, which was actually going to be my next question to you, Neelkanth, as to what the expectations are with regards to what the priorities of this new government should be, and whether it appeals to the market sentiment or no is a different question altogether, or whether they actually tackle issues on ground like farm distress and the others. So in that sense, from a market standpoint, expectations shouldn't run too high, right?
Exactly, and I think the market expectations are also suitably vague in the sense that everyone kind of expects that things will revive or that the government will do something. Oh, historic mandate, wow, solid mandate, and now they're going to do something. But I don't think there's a lot of clarity on what exactly is expected, and this is nothing new. I mean, we have been highlighting that over the last 7-8 years that, at least on these topics, that everyone wants reform, they just don't know what reform is. I mean, they know what reform is, but what reforms are likely, or what is it that they would like to see. So I think on some critical issues like, say, labor, which has, of course, long been discussed as a big problem in India, I think labor law reform, there's a lot of background work that has already happened in the government. So the 40-45 labor laws that have been passed in piecemeal over the last 7 decades, maybe 8 decades, are very frequently, contradicting each other, and a lot of complexity which we all know about. The government has tried to streamline those, so the intent is to repeal those older laws and replace them with 4 codes: code on wages, code on labor, code on social security, and code on worker safety and health. The code on wages has already been introduced in the Lok Sabha in middle of 2017. It has gone through a standing committee. As you know, every new law must go through a standing committee. And it was too close when the committee report came out. It was too close to elections for the government to do anything about it. The code on labor is currently with the cabinet, the previous cabinet, and the new ones get set. So my sense is that this is something that can be undertaken. So they have done it for a few states. So using provisions in the constitution where states on concurrent subjects could do their own laws, Rajasthan, and then followed by MP, and then Andhra Pradesh have already modified their codes on labor. This could also actually be done at a central level if the government passes this. So these are things that perhaps the government can do, but not something necessarily that will affect earnings in the next 12-24 months.
So according to you then, while we're talking about the earnings, do you see the high price to earnings multiple getting offset by a potentially higher growth rate in the EPS?
That's right. So one of the, and this is why, whenever I have to start a teach-in for someone who's looking at India for the first time, the Indian market for the first time, I start off by saying, look, the market and the economy are very different. So the economy may or may not have grown at 7%, 7.5% in the last 5 years. There was some growth, which we all know, but it didn't seem to be really reflected in corporate earnings. And the converse could actually happen in the next couple of years as the economy kind of slows, not very, very sharply, but it is clearly slowing. But earnings growth for the bigger indices could actually pick up, or at least be in the teens. And I think the 31% that FY20 consensus is at is perhaps a bit high, but you could see a 2 handle on the earnings growth for the Nifty in FY20. So it is an expensive market, but then so are almost all other equity markets in the world. The premium has not expanded really. And within the market, I think it is prudent to be in the stocks and sectors where there is growth. So banks, which have been our preferred pick for quite a while now, have already done very well. They are on the Z score, which is how many price to book, how many standard deviations away from your average price to book multiple you are. Z score, they're very expensive. But I think that even if there is no further multiple expansion, given that earnings growth should be quite steady over the next couple of years. I mean, very few people realize that the Nifty, the 8 banks in the Nifty could have a profit of combined profit of close to ₹1 trillion in FY20. As you know, banks have a very cyclical nature, so the more profit they generate, the more the capital for growth, and so therefore the medium-term prospects are quite bright. So yeah, so those are the sectors that we would focus on. But for the Nifty and the indices themselves, the high PE multiple is a global phenomenon. I would think that with bond yields globally falling again, tremendous global uncertainty, those multiples will not get challenged. And if India sees the kind of earnings growth that we think it will, then the broader indices should be fine.
Neelkanth, for the sentiment around these earnings or the market to be fine as well, would the healthy dose of reforms be a necessity, or would you believe that the markets would do well as long as the numbers come in, even if the larger strategic reforms don't get done? I mean, in your note, you highlighted a lot of things. A lot of people that we spoke to yesterday spoke about how strategic privatization is a very, very key ingredient in all of this as well. Assuming that all of those don't happen at a very quick pace, but if earnings come back, do you think the markets will be sanguine?
I think so. I think, you see, the world is a very nasty place right now for investors, especially equity investors and people who want to look for growth. And even though we may slow to 6.5%, I think that's still pretty sturdy growth on a 3 trillion economy. So I think it is quite, that may suffice. In fact, the strategic reforms that we talk about, right? See, there is no reform that you can do without disruption. No meaningful reform can be done without disruption. There is no painless reform because every economic reform is about taking from one hand and giving to the other, right? There are, I mean, from a system design perspective, it is in everyone's benefit over the medium term, but in the near term, someone loses. And so even if you do, say, for example, direct tax reform, I mean, there will be lots of benefits that will be taken away from some industries. The headline tax rate will come down. I think it's in aggregate in everyone's benefit. But as these things happen, there can be unintended consequences. There could be companies that could see a sharp downward revision in earnings. And so it will be disruptive. And that period of disruption, as we saw with the GST, I don't think anyone debates the GST was in the long-term good of the country. But it has been disruptive. And it creates a level of uncertainty which actually the market in general does not like. So we have to be very careful what we wish for. And secondly, the people who are actually, I mean, so everyone has, I think, solid reasons to expect or rather to demand a certain set of reforms. But we have this tendency of converting our hopes into our forecasts, which we have to resist when we are looking at markets and investing. It is not the prescriptions that matter, but the predictions that matter. So there are a lot of things that I would wish the government focuses on. I think energy is a big risk for the economy, energy imports. I think agriculture is something that we need to address very aggressively. I think the NBFC problem needs to be precipitated, but given the way things are progressing, perhaps it will be allowed to find its own course. So there are things that I would want to see happen, but I cannot make them my predictions. My predictions have to be what seem to make sense from the government's perspective as well.
Okay. Let's talk about one which has already been in force. I mean, we can't have a conversation with Neelkanth and not talk about arguably the biggest reform over the last 2 years, which is GST. One has to admit that the outcome in terms of monthly inflow into the kitty hasn't been as strong as one would have envisaged. Higher numbers have been cited as one-offs. What is your core thought? Because I remember a conversation last budget, Neelkanth, wherein you took it to a drawing board and tried and explained why people are not quite understanding the pace at which the numbers could move either direction. What is your sense now as almost a year has passed?
Yeah, so see, clearly last year was a bit of a disappointment. I think the economy started slowing. I think a lot of the nominal growth that we expected on the high tax drivers like cars, like steel, cement, petrochemicals, plastics, so these are very large drivers of indirect tax collection. And because oil prices went up but only for a bit, steel prices did not really change much, and car sales slowed. So all of these, I think this economic slowdown led to a bit of a negative surprise. But last 2 months have been quite surprisingly positive. So March collections were positive. There have been stories that look, there was a bit of a pull-in to meet the central targets or even the state targets, and people were asked to contribute more than perhaps needed to pay. But what was surprising was that despite what could have been a pull-in of revenue, April seem to still have about 10 odd percent growth. And this was, if you remember, on a base which includes that, things like paints, which are a reasonably large contributor to GST, had seen a rate cut. So adjusted for that, it was still at 11-12%, which is not bad. Has it led to the acceleration that was perhaps expected? Not yet, but I think enforcement has been a bit deliberately, no one has been asked. Everyone is just paying voluntarily what they needed to pay. And from what I gather, a lot of changes are happening already. And when we look at the aggregate numbers, say for FY19, we also have to remember, and this is sadly not something that the government gives enough detail on, but people in the government have said that almost 1.5 years of refunds were processed in the last year. So adjusted for that, the growth would have been actually much better. So a lot of the refunds that could have happened, and that affects 1-2% of growth. So I'm not yet very pessimistic on the prospects. I do think that as better enforcement happens, meaning people are asked questions, I think the collections and the tax buoyancy should be better. Will it be as strong as what has been budgeted in FY20? Time will tell, but there should be, I think, better growth. And the last 2 months have been actually reasonably encouraging. And for one of the reasons that the government may think that the economy is not slowing as much is that GST collections have actually been quite okay. So I think that GST has not delivered as much as it could have, but with better enforcement, with some tweaks to rules, with some tweaks to the software, I think it is possible that the growth this year is significantly higher than the nominal GDP growth.
So then the question that I have is, if you're not certain of the tax buoyancy and the balance sheet looking as stretched it is, and the number of areas at which the government has to tackle, which all require large dollops of cash, be it PSU banks and some bit of recapitalization that is being spoken about, or liquidity injection within the NBFC space by and large, or the infrastructure spending, all of which are large numbers. How does this happen?
Well, I'm not questioning the government's arithmetic on the tax collection side. I'm just saying that there should be better buoyancy than we saw, how I would look at buoyancy is the percentage points ahead of nominal GDP growth that you see tax collection coming at. I think on the direct taxes side, still there is, I think there's been very healthy trends, and while there was a bit of a slip up last year, I think compliance, enforcement, etc., is going to drive some improvement. I am not, as I said right up front, I don't think the government has the fiscal room, or I would say even the intent to use that fiscal room to boost consumption and to drive and accelerate growth in the economy. Their approach would be much rather, and I would rather keep it that way, that you show some fiscal discipline and that results in lower interest rates. I think one of the problems in the economy right now, and then this is our problem with obsessing with the government, is that we have seen the worst side of two things. The first is that we have seen all the negative side effects of weak inflation, which is stressed farmers, stalled transmission of incomes from the rich to the poor, but all the positive side effects, which would have meant significantly lower interest rates, have not come about. Now, if you go back 40-50 years and you see the commentary, the economic literature, people have assessed why India's manufacturing and exports were so weak. One of the very big factors was that Indian companies borrow at 12%, Chinese could be borrowing at 6%, how can we compete? Now, why did we borrow at 12%? Because we had high inflation and we had high fiscal deficits. And the government used to appropriate a lot of the financial savings. Now what we have is that we have low inflation, and we have also, while we can carp about the public sector borrowing requirements and all that, there is some concern in absolute levels, but on relative levels, in fact, compared to India's own history, these are at historic low levels, when financial savings, in our view, have actually done far, far better than what is perhaps even being reported by the RBI. So I think the crowding out is a lot lower. So what we have is that, because you're seeing the worst side of both issues. So the government on a cycle which is adjusted by the pay commission. So if you think about pay commission cycles, once every 10 years, the salary and pension bill goes up by 2.5% of GDP. You cannot think about fiscal consolidation or fiscal deficits without realizing or without incorporating where you are in the pay commission cycle. We've gone through the pay commission without the fiscal deficit going up, and yet the term premiums, the gap between the repo rate and the 10-year bond yield is still very high. So what you have is that the government's consumption stimulus that used to come once every 10 years has been much more feeble this time. That I think is a prudent measure. This should have resulted in, because this has had a growth impact, this should have resulted in lower term premiums. We have not allowed that to happen because of poor signaling on the monetary side. And we have weak inflation because of food inflation, and because of that there is stress on the agricultural side. But the positive side effect of that in terms of lower rates has also not happened. This discordant policy is what I think is the root cause of our current slowdown. And I think it needs to be addressed by significantly lower interest rates. I think just relying on the government to do the needful means that we are pushed back into the old regime where the government ends up spending too much, and the government cannot spend anywhere as efficiently as the private sector can, and therefore causes inflation again. So we go back to the old regime, and some of the political alternatives that were being discussed in the elections were quite worrying, that because we have distorted our monetary policy so much, we were forcing the political system to go back into that old regime of high inflation and high fiscal deficits. I don't think that's desirable. I think what is needed now are lower rates.
All right, which obviously lays the prominence in what the RBI does next. But Neelkanth, I want to pick up the angle of the consumption slowdown. Now, two parts to it. One, the fact that NBFCs have been holding back and there's not enough fuel going into the engine for SMEs, MSMEs. Rural income has been declining. Inflation that we all are happy about, which stays in the RBI's comfort zone, that in a way suggests that rural income is stagnating. They don't have much of disposable income, which again sputters the consumption engine. There's no spending, and therefore you don't see that much growth coming in. So this double-edged sword which is plaguing consumption, do you think going ahead there could be a solution, a reasonable enough solution which the market also likes?
But the first thing is I don't see such a solution. So that's a short answer. I struggle to imagine what that solution could be, because partly driven by political compulsions, the government, against I think almost all its instincts, did embark on PM Kisan, which is to transfer income directly into the hands of the farmer, of the weak farmers, the smaller farmers. So I think beyond that, I think what may happen is perhaps some farm credit pickup would happen. That's a natural consequence of, or the next step after the spate of loan waivers we saw. So agricultural credit growth perhaps will pick up. I think there will be more money in the hands of the farmers. That can act as a fiscal booster as well. But beyond that, I don't see anything that the government can do or needs to do or must do where that can actually boost consumption. So why is consumption slow, right? I think so the first and most important thing is that the pay commission boost that happened in the 5th and the 6th pay commission was 2 to 2.5% of GDP, which meant that, and these are very potent consumption boosters. We've often discussed this, but it's worth repeating that if you give that kind of a hike to a government employee who then realizes that these numbers are never going to come down, the change in consumption behavior is quite dramatic. They immediately buy bigger cars, bigger houses, and then this massive and potent consumption stimulus takes a long time to trickle through to fade out, because the ripples last much longer. In the 7th pay commission, the increase was 1% of GDP, so it was less than half of what we have seen in the previous 2 pay commissions. So this consumption stimulus faded much faster. The second thing that is happening is also this is an income problem. So if money supply growth, which is 10.4, 10.5%, much below what we think GDP should be growing at, and has been lagging GDP growth for the last 2 years, there is a serious there is a problem in the financial system. And I think that needs to be addressed. So if that does not happen, I think income generation, because see, GDP is finally incomes, right? So income generation then stalls. And as income generation stalls, I think consumption has to slow down. So this is what I think is happening. Till the time that we see money supply pick up very nicely, and necessary for that is a precipitation of the NBFC issues, which I think is unlikely. Perhaps getting the PSU banks to grow very rapidly, which also, given that the first priority for the government may be to consolidate the PSU banks, it may not be happening in a hurry. And the third is a sharp drop in the rates for the borrowers. I think interest rates should be 2% lower. They can be 2% lower. I think repo rates can be 100 basis points lower. I think the term premium can fall by 70, 80 basis points. I think the credit spread is elevated as well. All of this put together is like, imagine mortgage rates falling from 9% to 7%, what it does to the real estate market. The point is that these things need to happen. I think they can happen. We can build a case why they should happen. But I don't think they're very likely to happen. Those are the things that we need to be discussing, because if it takes 8 months for the MPC to cut rates by the quantum that it needs to, I think then growth for the next year is going to remain slow.
All right, Neelkanth, it was a pleasure chatting with you and gaining your insights. Thank you so very much for joining us on this special coverage.
And viewers, thanks for tuning into this broadcast.